Hi, I'm Rick Kaler. Thanks for joining me. One of the low points of my career was the day that I lost one of my largest clients because another advisor, and in her words, had found a way to put their clients into the lowest cost shares available only to large institutions. Now, this experience was especially painful because through my office, the client already was invested in those very same low-cost shares, only available to large institutions. I just hadn't made sure the client knew that. It was a significant mistake in communication. Many investors don't know that most mutual fund companies offer a special class of share available only to those investors with sizable minimum investments. So those sizable minimum investments are usually over $1 million per fund. These shares carry the lowest expense ratio, and that's the annual fees that are paid to the fund manager, of any other share class. And usually they waive any front-end or trailing sales charges in these shares as well. Because it's usually large private and public institutions that have the large sums to meet the minimum investments, these are normally called institutional shares. Most investment advisors who don't receive commissions have special access to institutional shares through their custodian. Over the life of your investments, these low-cost shares can result in thousands upon thousands of dollars of savings. I mean, it can really add up. If you're in a class A, B, C, or R share, and you can find this out by looking at your statement from your brokerage company, the expense ratio is higher than the fund's institutional shares, which are often called iShares. Sometimes they're called other things, but usually iShares. The other share classes often include a commission that's paid to the broker or the advisor, or maybe a fee that's paid to a custodian. The point being they have higher expenses. The average annual expense ratio of these funds is around 1.25%. That's just the blended rate of all your bond funds and your equity funds. But that charge can drop to as little as 0.03% when an advisor places clients in institutional shares. That's a huge difference. It's a 1.22% difference. Let me give you this example. Take RIDEX S&P 500 fund. They're Class C shares. If you're interested, the ticker is RYSYX. The RIDEX fund tracks the S&P 500. So it's an index fund, just like hundreds of other index funds. The difference with this particular index fund is it charges investors 2.33%. That's astounding. As an alternative, this is how astounding it is. You can buy the retail share of Vanguard's S&P 500 index fund, which, if you're into tickers, it's VFINX, with a cost of 0.14%. That's 2.33% to 1.4 or 0.14% for the same exact stocks. That's a 94% savings. But it doesn't stop there. You can still save another 71% if your advisor places you in Vanguard's institutional share of the exact same fund, which is VINIX. That has an expense ratio of just 0.04%. So the retail is 0.14%, and the institutional share is 0.04%. That's 71% less. Now, any fee advisor who uses a major custodian like TD Ameritrade, Schwab, or Fidelity has access to institutional class shares. Advisors not only can use them, but they're strongly encouraged to use them by the SEC. SEC wants an advisor, if at all possible, to use an iShare versus any of the other classes of shares. And advisors who don't put their clients in institutional shares had better have a good reason. A good reason is perhaps the company doesn't have an iShare, and that does happen. Or the client is so small that using a higher cost class of share eliminates a transaction fee. So to the investor, it's actually cheaper to use the A share or some other share than the I share. So there are definitely reasons to use A shares. But the point is, it needs to be in the client's best interest to be using them. It had never occurred to me to use our firm's use of institutional shares as a selling point to prospective clients. After all, every other fee-only investment advisor not only does the same, but as I said, is basically required to do so by the SEC. If you don't use the services of a fee-only advisor and don't have the $1 million minimum per fund to get into the iShares of the funds, you have several options. The first would be to look for a similar fund with a lower expense ratio, like the example above of replacing the RightX 500 with the Vanguard 500. Huge difference. You could also consider an online robo-advisor that for 25 to 50 basis points, that's 0.25% to 0.5%, would put you in institutional shares. Or you could consider engaging an advice-only planner. Whatever you do, take a look at the share class of your mutual funds. If they are not iShares, ask your fund company or advisor why they aren't and how you can move into the iShare class. The savings could be phenomenal. Thanks for listening.